On Wednesday, the Federal Reserve made a significant move by cutting its key interest rate by a substantial half percentage point. This is the Fed's first rate cut in 4 years, aimed at supporting the economy as the labor market shows signs of slowing. The central bank opted for this aggressive cut to jumpstart a series of expected rate reductions, following recent signs that inflation is easing. Despite concerns about job growth, the Fed signaled that the economy remains stable and forecasted only a modest additional half-point reduction for the rest of the year. The Fed has gained more confidence that inflation is trending towards 2% and believes that risks to both employment and inflation are balanced, the Fed stated after a 2-day meeting. The statement also noted that inflation has made notable progress towards the central bank's goal. Fed Chair Jerome Powell acknowledged a slowdown in job growth, saying, "Payroll job creation has slowed in recent months, which is something we are closely monitoring. Inflation risks have diminished, but employment risks have risen." However, Powell emphasized that both the economy and the job market remain in solid shape, explaining that the rate cut is meant to sustain that strength. "We're acting now to support the labor market while it's still strong, rather than waiting for layoffs to start." Oxford Economics chief U.S. economist Ryan Sweet believes the Fed should have begun cutting rates earlier in the year. "Today's half-point cut seems like an attempt to catch up," he said. "The Fed's decision is viewed as a preemptive strike to increase the likelihood of achieving a soft landing, where inflation is controlled without triggering a recession." The Fed's rate cut lowers its benchmark interest rate to a range of 4.75% to 5%, down from the previous 23-year high of 5.25% to 5.5%. This reduction is expected to ease borrowing costs for Americans, particularly for mortgages, credit cards, and loans, though it will also result in lower savings account yields. What's ahead for interest rates in 2024? Fed policymakers predict the rate will drop to a range of 4.5% to 4.75% by the end of this year, with 4 more quarter-point reductions planned for 2024, eventually bringing the rate to about 2.9% by the end of 2026. However, opinions among officials are divided, with some favoring a smaller rate decrease and others pushing for a larger reduction. Is inflation actually decreasing? The Fed has worked aggressively to curb inflation, hiking rates from near zero during the pandemic to combat a sharp rise in prices. Inflation has since eased, falling from a 40-year high of about 7% in mid-2022 to below 3% in 2023. Although prices surged unexpectedly earlier this year, recent data shows that inflation is trending down. The Fed is increasingly confident that it is on track to meet its 2% inflation target. How is the job market holding up? After a robust recovery from the pandemic, the labor market is now showing signs of slowing. Job gains have tapered off, averaging 116,000 jobs per month from June through August, down from 211,000 the previous 3 months. While unemployment has ticked up to 4.2%, layoffs remain low. Some experts believe the rising unemployment rate is partly due to an influx of immigrants entering the workforce, but not immediately finding jobs. What does this mean for credit and housing markets? The interest rate cut is expected to bring some relief to consumers, potentially leading to lower credit card rates, although experts caution that the drop may not be immediate or dramatic. On the housing front, mortgage rates have already started to decline, hitting their lowest point in over a year and a half. While mortgage rates aren't directly tied to the Fed's actions, they tend to follow the trend set by the central bank's monetary policy. Political reactions to the rate cut. The rate cut has drawn mixed reactions from political leaders. Donald Trump, the Republican presidential nominee, criticized the move as too drastic, suggesting it reflects a weak economy or political maneuvering. In contrast, Vice President Kamala Harris, the Democratic nominee, welcomed the decision, but emphasized that more work is needed to lower costs for working families. Impact on the stock market and global economy. U.S. stock markets initially reacted positively to the Fed's announcement, but ultimately closed down slightly by the end of the trading day. As for international travel, the rate cut could weaken the value of the U.S. dollar abroad, though experts say exchange rates tend to adjust in anticipation of such changes. Looking ahead, the Fed's path forward. Fed Chair Powell reiterated that the central bank will continue to monitor inflation and employment trends closely, adjusting its approach as needed. While the Fed has managed to bring inflation down without sparking a recession thus far, the path forward remains uncertain as economic conditions evolve.